Presidential Wealth Management. In the next hour, learn how to protect retirement investments and income in a down market, how not to give in to fight or flight, and the things you can control.
During the last few weeks, we've been answering a lot of questions, and we've enjoyed every minute of it. That's because answering your questions in a way that you understand helps you make important decisions. So in the next hour, we're going to share the questions we've been asked the most and the answers. And we invite you to send us your questions as well. I'm Keith Weinman, along with Taylor Leary at Presidential Wealth Management.
Good afternoon, everyone. Thank you for being on today. Keith, thank you very much. It's always nice to see you. Today is going to be a fun day. We're going to be covering the 5 major areas that people are concerned, especially in today's market. But before we get to that, I want to touch on a few housekeeping items. So the first is, we know that you have questions. We've been fielding questions from our clients, pretty much multiple times a day, basically 7 days a week for the last 8 to 9 weeks. And it's because of what's happened since essentially the middle of February. And so with that, there are going to be questions that you have throughout. There is a chat feature. We want this to be a very interactive experience, but we also understand your privacy concerns. So what we have is a chat feature that only we can see. So if you send us a question, not the entire audience will be able to see that, only you. So please, you'll have that anonymity, if that's the right word. You'll be anonymous, and you'll be able to ask those questions in a very safe environment. We know that everybody has the question, and so if you even think it's the silliest question, ask it, because there's other people that are asking the exact same question, but unfortunately are a little afraid to ask it. So we'll be covering the top 5 questions that we get and issues that we're seeing people face right now, but we want to know what questions are on the top of your mind. In addition to that, we'll be also interacting with you by using the poll feature. So throughout the conversation today and the discussion, we will ask you for your response and your feelings on various questions pertaining to the economy and kind of where things are from a financial perspective. So be on the lookout. We will certainly notify you when we're going to be publishing those polls. And we'd love to hear your feedback, because over time we've seen some interesting numbers and some interesting changes to some of the questions that we've been asking. And so we would love to hear what your thoughts are just on where we are today. And what it does is gives us a good snapshot in time of how you're feeling, what your headspace might be looking at. And then finally, how to connect. We'll give the opportunity to connect with us. We do have clients. We also have people that have subscribed to our newsletter that are on today, and we would love to connect with you. So if you work with us, if you don't yet work with us, we will give you that option to connect with us at the end here, and we'll give you those choices as to how to do that. With that, Keith, what are we going to be covering today?
Well, an interesting thing happened in all of those questions we've been answering over the past couple of weeks. A trend emerged. Most people were asking variations of very similar questions, which indicates we sort of all have the same concerns. Now, you may have those same questions. And in a few moments, we're going to tell you what those questions are and our opinion of what you should do about them.
Yes. So like I said, you'll have the opportunity to connect with us, but we also want to open it up to you all and provide a value add, if you will, as to what do we do and what's going on. We know that a lot of the times people come to us for, to get advice, to get insight, to get guidance, especially on their investments. And so what we're providing is a free portfolio review. This could be your 401k, your current investment strategy, your IRAs, or your individual accounts. It really doesn't matter. We can do a free portfolio review that will look at the various risks that you might be taking, what might be some holes that are going on in your portfolio. We just know that in our experience, there are, you just don't know until you don't know until you know. And right now we've seen a lot of cracks and a lot of holes in the clients' portfolios who were taking more risk than they actually believed they were taking. So I will open that up, use the offer button on the right-hand side to schedule now. That will send you to our website where you can sign up for a free portfolio test. Free portfolio test with one of our advisors here at Presidential. So to start things off, we always like to set this up as where we've been. So Keith and I have been doing this for a number of weeks now, and each week things change dramatically. And so just this past couple of days, we saw something unprecedented. If you've been in the oil markets for 80 years, 100 years, you've absolutely never seen this type of market action. And what I'm saying, or what I'm pointing to, is what we saw earlier this week. And that was a negative oil, or actually the price of oil went negative. Keith, I know you talk about this on the radio a lot. Let's dive into it.
We had a lot of fun explaining this on the radio and heard from listeners that they appreciated us putting it in English. There are two reasons to invest in the futures markets. One is to trade the contracts and to buy and sell them. The other is to take delivery of the oil. What you're looking at here on the screen is a chart of the June oil futures contract. This is West Texas Intermediate. It's the U.S. benchmark crude. Now, this is the June contract, and this is, I believe, yesterday. And you see it takes a dive. Take a look at the right side of that screen, and you'll see that dive that it took. Well, that's not what got all the attention. That actually was in sympathy with what happened in the May contract. The May contract was up for expiration on May 20th, okay? Just a day ago as we record this. And remember the two reasons to buy these contracts. One is to trade the contracts and hopefully make some money. And the other is to take delivery of the oil. Well, all the people who were to take delivery of the oil had no place to put it. You may have heard in the news that the U.S. is running out of places to store oil. Most of our oil is stored at a complex in Cushing, Oklahoma, and that's where that oil would be delivered. Well, the people who had the contract to take delivery of that oil determined that it was less expensive to offer somebody cash to take that oil off their hands than it was to take delivery of the oil and pay to store it. And so that's what happened. They started looking for people to take the oil upon delivery, and they offered to pay them. And when you hear that oil was $30 in the negative, 30 some dollars in the negative, that was the May contract for West Texas Intermediate delivered at Cushing, Oklahoma. And when you hear that oil went negative, that was 124,000 barrels of oil that would be delivered in the next few days to be stored or not stored because they don't have the room anymore. There's so much oil already being stored at Cushing, Oklahoma. And oil went negative because the people who were going to be forced to take delivery of that oil said, we'll put $30 a barrel out and see if we get any takers. And the takers would obviously be people who had some way to store that oil. And so that May contract expired. So we ask, where do we go from here? Well, you're looking at the June contract. Will the same thing happen a month from now? Probably more than likely, because what it's going to take to solve the problem of where to store all the excess oil is production has to drop and demand has to rise. If demand rises, we're back to our normal lives. We're using more oil. We're driving, we're flying, everything, everywhere oil grows. With the economy shut down, there's lots of room for improvement on that side of the equation. On the other hand, production is slowing down. I've seen a statistic that US production is down about 900,000 barrels a day. But as we've mentioned in the past weeks here in this webinar, turning off an oil well isn't like turning off the garden hose. Now, the producers want to preserve that well so they can bring it back later this year when oil prices have recovered. And the forecasts are we may see oil in between $40 and $60 at the end of the year 2020. So they have to be very careful in shutting those wells down, and it's a slow process. So production is still up there. So production has to drop. Our demand for oil has to rise as we restart our economy, and neither one of those are a quick solution. They both have to happen, and they'll both happen relatively slowly. So Taylor, that's pretty much where all the headlines were. And keep in mind that was only 124,000 barrels of oil. Don't fall into the trap of thinking that that was representative of what's happening in the overall oil market, because it's not.
Yeah, and I think that's an interesting point. That it's, yes, it was for a small portion of it. The one thing I did post here, it was a poll. It's our first poll here. Is in 6 months, where do you think oil prices will be? Right now, for context, as of the close of business today, roughly about almost $17 a barrel. And we'd love to hear what you have to think, or what you think. Will it bounce back to pre-pandemic levels? So right around 50 or just north of $50 a barrel. Will it go lower, historic lows with the supply glut too great to overcome? Stay about the same until our economic situation is sorted out, or just, I have no clue, which is totally a fair answer. So just take a moment, answer that. Obviously, you might have a nuanced answer to this, but you probably fit in one of these four camps. Love to hear that. Right now, we're having 100% of the folks that are responding say, I have no clue. So I love it. Clap, clap. I'm going to give a small golf clap there, because that's certainly showing, how challenging it is to predict what's going on out there.
Realize airlines are flying empty right now, and airlines are the ones that buy those futures contracts to take delivery of the oil. Yeah. Airlines insulate themselves from the volatility in the oil market by doing that. But airlines are flying empty. We're not driving. That may start to change very, very slowly next week. So again, it's a slow process. And yes, it does affect stocks and the stock market. In part, interestingly enough, it affects stocks and the stock markets in ways that it shouldn't, because the public largely doesn't understand how the oil trading system works and how oil is priced and our dependence on it. So all of that has to sort itself out. And I applaud the people who are admitting on the poll that I have no clue at 83%, because that's where a lot of experts are. And forecasts that I've seen in watching this story over the past week or so, again, range between $40 and $60 a barrel around the end of the year. I'd bet more on the 40 than I would the 60.
Well, that's perfect. Well, that's a great insight on the oil markets and what's happened over the last 3 or 4 days. And it's certainly something that we will be watching very closely. Now, let's just jump right into our very first issue. Or I guess what we can learn from this. I always like this. I put this on the last couple of weeks. And just with all of the volatility and kind of the crazy actions in the market, be it the bond market, the oil markets, or the stock markets, I think there's something to be said about this graphic and what we can learn from it, and trying to make sense of it. So without further ado, let's just jump. What's driving the market? This is something I get a lot. What's driving the market, and where does it go from here? Again, I'm using the proxy as the stock market here, because this is what a lot of clients are asking. what the heck is going on? And I guess I'll ask you, what do you think's going on here, Keith? And what are you talking to your clients about?
Two very good questions. What I think is going on largely is our herd instinct, something that we're born with. And, these markets, there are millions and millions and millions and millions of people doing the trading. And unfortunately, a lot of us are driven by herd instinct. And we've seen that. And the word for it, is panic. And there was panic for a while. But interestingly enough, this market has recovered more than half of its loss. And that is dramatic, and that's somewhat unprecedented. Where it will go from here, that's a good question. Over the past year, a lot of us at Presidential Wealth Management, I know I've been telling my clients that we had to be very careful at how they were positioned in this market. First, we had to be careful of how much they were exposed to the market, because you remember the bull market was getting kind of long in the tooth, going 11 years. That had never really happened before either. And so I was telling a lot of people, let's position for at least a correction, but let's position for a bear market. And so many of my clients were positioned for this. And you'd be surprised, Taylor, at the number of calls I got from people that said, how much cash do I have and what can we buy?
Yeah.
They were conditioned. They know that we had made long-term investments. They realized that every incident like this in history, the market has always recovered. It's just a matter of time. And they know that their income hadn't changed. And
right.
So those are the conversations that I've been having with my clients, and I feel very fortunate that we had done our work, we had planned, and here's the most important thing: we expected in their plan, we expected the unexpected.
Absolutely. Well, that's kudos to you, and I know that they're planning. We are planners first. And that's part of that portfolio stress test, is understanding if the investment strategy that you're deploying is in line with your financial plan. And at the end of the day, are those two things in alignment? If they're not, then it's worth having the conversation at the very least. The one thing that I look at driving the market, we're up about 26% from our March 23rd lows, and that's both on the S&P and the Dow. And with that, it's been a very interesting rocky ride to get there. And there's a lot of challenges that are ahead of us. Right now, we don't know. I think it's really too early to tell the true economic impact of basically worldwide shutdown that we've seen. We're here in Colorado, and we saw that, just recently, early this week, we got the safer at home order, which is basically to say one step away from the stay at home order. And now we're starting to open things up here at the end of this month. And so we don't know what the real economic impact is. So this bounce back, it seems a little too optimistic in my personal opinion. Now we're at 24,000 on the Dow, and it just seems a little too optimistic to be here. So my poll question to you is, where do you believe the stock market will go from here? Will it soar higher to pre-pandemic levels, very similar to what we looked at in the oil? Will it drop lower? There's more pain to be had in the future. Will we test 18,000 like we did on March 23rd? Stay about the same with significant volatility, bounce around? That seems like a fairly logical step. Or again, I have no clue. In the end, it's really, really challenging to hear. I'd love to hear your feedback on this particular question, because I still think that we have some pain to be felt in our economy. There was a report by Bank of America earlier this week that said, basically, when you combine a bear market, which is what we were in between early or mid-February till late March, we were down about 37% on the Dow, that would be considered a bear market. And you couple that with recessionary environments. I think at this point, it is almost inevitable, if not 100% likely, that we will see recessionary environment. We're almost 30 million people that have claimed unemployment benefits over the last 4 or 5 weeks. And so with that said, again, the economic blow from what we've seen is not even felt in the real way. And with that Bank of America report, when you couple those two things together, it takes about 11 months to rebound. So by this rebound of about 25 to 26%, that would be a complete anomaly in the markets. And I'm a believer in statistics. And you know what? Outliers are outliers for a reason, because they don't happen all that often. And this might just be that anomaly, or it could be more likely that it's going to take a long slog to get out of this hole.
You know, we've been in a trend recently when a lot of those historical comparisons haven't really held true. A lot of things have changed, and a lot of things are about to change. The things that have changed over the lifetime of this bull market include a different way of looking at things, include political perspectives, include generational change, include the influence of technology. The influence of technology. Think about how fast things happen, about how fast the market and people react to things. Why? Because information is 24/7, 365, instantaneous and worldwide.
Yeah.
Talk to a person, Taylor, we could be having this conversation. We could be both halfway around the world from each other, and we could be having it for free.
Yeah.
How fast does information spread? And you know what that goes to is what we've seen, I think, become the new normal. And that's another question we're asking ourselves these days. Exactly what is the new normal? Well, I think we'll get into that a little bit more as this hour goes on. It certainly has yet to be defined, and we'll have a few more things on that for you as well.
Yeah, so if you are unsure of the direction of your portfolio, this is where a portfolio stress test would be a great opportunity to kind of have somebody else look under the hood and say, what's going on? So click the button on the offer tab to schedule your one-on-one call with an advisor so you can start the process to do your portfolio stress test and basically understand where is the risk in your portfolio, and is that a little bit too high than you're actually used to, which then you can go to how do you recalibrate in what's going on. So I'm going to jump to the second question that we see with a lot of folks here. In fact, it was kind of interesting. Let me just share my screen again here. And that is, what does today's market conditions what impact does today's market conditions have on my financial plan? Now, this is interesting. I'll kind of take the reins here, if you will, Keith. I got a call from a client here, and this was actually just yesterday. And they, I had a scheduled call. They said, Taylor, how bad is it? I was like, oh, how bad is it? And you were speaking to setting your clients up for success. Now, these folks are in retirement, and they said, how bad is it? And I said, well, it's not bad at all. What do you mean? They're like, are we going to have to go back to work? And so this is where I think this fear grips us, because we just don't have that known, right? There's a lot of unknowns out there, which we'll talk about here in a little bit, that we don't know what is the real impact of what has happened. And in the reality of things, this is not going to change what many of my clients eat for dinner. I use that term all the time because it's to say, you know what? Yes, we got a bit of a skinned knee here, but let's dust ourselves off and move forward. Maybe this is a really great opportunity to recalibrate your portfolio. Look at some things that maybe are shifting around, and understanding how the real impact of the bigger picture is. Maybe you just have a small portion that's exposed to the stock market, and maybe that's seen a lot of volatility, but the other parts of your portfolio have not been impacted at all. But because of all the headline risk and all of the things that are out there that are just 24 hours a day, just hammering us with fear, uncertainty, coronavirus, this many people are dying, that you're thinking, oh my gosh, I got to go back to being a Walmart greeter, or I got to go back to, doing something, and maybe that's just not the reality. Keith, what are your thoughts, and what have you been seeing out there?
My thoughts are that person that called you and said, "How bad is it?" Had opened a statement and went down as far as the balance of the account, and that was when they dialed you.
No, they didn't even open they said, can we open our statements now?
Really? Oh, okay.
And I was like, yes, of course you can open your statements. But I thought that was interesting. They didn't even want to open their statements.
To most,
and when they did, they were pleasantly surprised, I have to say.
Good, yes. To most people, statements read like a Russian newspaper. I'm sorry. It is very difficult for clients, for you, even for us, to pull certain facts out of statements, and that's driven by regulation. So with that said, don't fall into that trap of looking at nothing but the bottom line. And when my clients call, we say, yes, you are down, but you're not down as much as the market. And you have some investments here. And in fact, the majority of your investments are hardly down at all. They're down a little bit, a small fraction of what the market went down, because the correlation between the market and those holdings is very, very low. So let's shift to what is important. Why you're not going to have to go back to work, because their income hadn't changed. You say, well, is that possible? Yes, it's possible. It's possible with very carefully choosing the investments that are dictated in a retirement income plan. And that's something, especially in times like this, you shouldn't be without. So what happens if you're armed for this in advance with, let's say, a reasonable amount, perhaps a majority of your investments in something that has very little correlation to the market, and its income will be steady, you can project it into the future. Then other portions of your portfolio, yes, are positioned for growth. This then is an opportunity, because well-operated companies, well-run companies that have stocks in the public marketplace, remember, the tide lowers all boats. Guess what? You may find them to be on sale, and this becomes a wonderful shopping opportunity.
Yeah, and I will, you and I were talking offline here, and some of your clients many of your clients are in or near retirement. And I have to say, a lot of my clients, there are a number of them that are also in that boat, but I also happen to work with a lot of younger folks as well. And when I look at, what's the impact of this on their portfolio, what they're a lot of the times asking is, can I still achieve my financial goals? Is that, so is that retirement income? Is that running out of money? Or gosh, in some of my cases, it's a down payment for their next house, or, it's being able to leapfrog the house that they're in to buy a rental property, or do something to that effect where they're building real wealth. And just because we have a bit of a bump in the road, so to speak, it doesn't mean that we're completely derailed. Now, I will say that they will be completely derailed if they make poor financial decisions. And this goes back to the behavioral finance side of things and understanding from a holistic approach. So taking that bigger picture view of what is the real impact. So we'll talk about this here in a little while, and that is the structure of your portfolio, whether you're 35 or 65. That all matters. And we have a really amazing strategy in order to make sure that our clients are really well protected during very challenging market conditions, and they have ways to make money and earn money and have that money grow for them so they can build a long-term, solid retirement plan, financial plan, and build wealth in a real way. So that's the other side of that. So is making good decisions during these types of markets, that's the most important thing that you need to be doing. So take a step back. If you're feeling panicked, if you want to press the sell button, take a step back and understand what, if there's been damage done to your portfolio, what does that really mean? If you don't know that answer, this is where you schedule that time for a one-on-one call with one of our empathetic, caring, and honestly, some of the best advisors that I've ever met in the industry at Presidential Wealth Management. Schedule that now. Hit the schedule now button. That'll take you to the landing page Just plug in your information and you'll be paired up or assigned to an amazing advisor here at Presidential, whether it's Keith or myself, or another one of our tremendous advisors on our team. So with that said, Keith, anything else to add to how you look at short-term financial ups and downs, market ups and downs, and how they impact your clients' investments?
Market ups and downs and how they impact my clients' investments. We've been pretty well set for most of last year for this to happen. Mm-hmm. So in some of their areas, like, yes, my clients own some growth stocks. And some of those stocks have been hit, but it's nowhere near the majority of their portfolio. Now I'm speaking, as Taylor laid out, I'm speaking for somebody who's approaching retirement, say within 10 years. It intensifies within 5 years, or somebody who's in retirement. And if you're younger, like Taylor, and you're in it for growth at this point in time, it's a little bit of a different ballgame. And still, if you're going to look at the glass half full side, this creates an opportunity to get stocks that are well positioned to move into the future, stocks that have enough cash to make it through these rough times, and stocks that are just well run. You can get them on sale. So we're talking perspective, we're talking context, and all of that is rather easy to define if you spend some time working out a well done financial retirement income plan, or if you're like Taylor, a well done plan for growth.
Absolutely. And I just got a message on the chat box. And again, as a reminder, use the chat box to ask questions. David, thank you so much for sending that in. And there is no technical minimum per se. There's another avenue. What we really want to do is align our personalities and our vision and goals. That's really what the account minimums end up being is, do you want to work with us, and are we a good fit, and do we want to work with you? So with that said, if you're feeling a little bit of uncertainty right now, and maybe it's a challenge between spouses, schedule some time. All it is a conversation just to see where we are, and that can start the ball rolling down the really amazing hill that I've seen people get that financial clarity from meeting with and using our system and the way that we go about financial planning. So yes, David, connect with us, use the schedule now button, and we will absolutely get you and your wife on the same page and show you that 1% in a money market is not likely going to be enough to live through retirement. So again, use the schedule now, but then also remember to use the chat box, folks. Would love to hear more of your questions. So Keith, going to jump to this next question here that we get, and that is, I made investment mistakes in 2001 and 2008, or I see this all the time. Is this time different, and what can I do to fix my mistakes? So this is a very big question, and I recognize it because when you and I were preparing for this, we were starting to get these questions, and it actually wasn't from clients at all. It was from people that came out of the woodworks that were like, hey, Taylor, I now need to have this conversation. I know you and I talked 2 years ago, but geez, man, I realized that, I'm in retirement and I'm watching my account every single day, and I'm too panicked to go even outside to check the roses or smell the roses or go, schedule that tea time. And so what I find is that these are folks that have made mistakes. Yes, Keith.
Watching my account every single day, really, you see, and that is our yellow lights and our red lights start to go off inside here when somebody says that to us. Realize that we are pre-programmed with a program that causes a thing called fight or flight. When we're confronted by something that is larger than we are, something that we can't control, and something that is going to do, potentially, it looks like it's going to do harm to us. And I'm talking about doing harm to all the money that we've saved for our future so that one day we can retire and enjoy the rest of our lives. That triggers fight or flight. Well, we can't fight because it's too big. And we feel helpless. So what do? We flee. That's the other side of it. And fleeing equals sell. And that could be a mistake that you've made in the past. You could have made it in 2008. This question goes back to 2007, 2008, the beginning of 2009. That was much different than this. That was a true financial crisis where banks were in trouble. This time around, this is caused by a virus, something that we really couldn't predict. Now, whether it could be prevented to a various degree at various stages of its getting hold, that's a whole separate week of talk shows. But we couldn't necessarily predict this. And it triggers fight or flight. And that call to Taylor with that gentleman saying, I look at my account every day, don't do that. Instead, make investments that you know are well positioned for where you think the market is going to go. And even in a time like this, the market is going to recover. So you make investments that are well positioned for the future. And don't look at that top line of that statement every month. Don't watch the market every day because it'll trigger fight or flight. And sooner or later, you'll go for the bait and you'll get in trouble and you'll sell something that you shouldn't have.
Yes. And I'll also add that the actions and the decisions that you make during uncertain times, so AKA right now, will dictate the success or failure of your financial future. That is the drum beat that I have been banging very hard over the last 8 to 9 weeks. And I think Keith has heard me say that probably 100 times. And it's because it's moments like this. I like to call them, your Braveheart moment, where you get the drum beat. And this is my moment. This is why you hire an advisor, is so you don't make these mistakes. And I get to be, the guy that, parades along and gives the rah, let's go speech, because people want to make decisions. They want to make irrational decisions. It's been proven time and time again that there's this part of our brain that acts irrationally. And it's just, to your point, this fear and uncertainty, and it's triggered. And it's our fast thinking brain that all of a sudden clicks, and then you make that decision. And it's where a bear is in front of you and you need to figure out if you need to pick up a stick and fight that thing or run like the Dickens and head for the hills. So I say that because we don't have any bears, but what we do have to fear is all the headlines, all of our past experiences. You are not your past failures. However, if you do not learn from what you've made failures in the past, then you will continue making those failures and you will continue having those, you'll continue to trip up. And that's where hiring an advisor like myself or Keith is a ticket to at least getting clarity and direction in your financial future. And that's where scheduling some time to meet with us, whether we're a good fit with you or not, it's hard to say, but at least it's a starting point to figure out what track you're on and whether or not we can help you and make you better off in this current environment that we're in.
And one of the things that Taylor alludes to in what he just said is not focusing on the rearview mirror. Look at a simple analogy. If you drive a car looking only in the rearview mirror, you're going to get in a wreck. Know what's behind you. Learn from what's behind you. And Taylor said this, but focus on the future. Turn those mistakes into a tool by taking that experience and saying, well, what am I going to do when I get into that position again? Don't beat yourself up. And you might say, well, I don't do that. You'd be surprised how many people do. How many people are so focused on the past and just refuse to budge off that. And that then goes to the value, as Taylor says, of having someone else to help you make those decisions, not necessarily to make those decisions for you, although if that's what you want, an advisor can do that as well. But the best possible way to use that relationship is to have someone who's experienced in the industry, who you can converse with, who you can learn from. Someone, I have a thing and I say, someone who listens more than they talk. They've gotten to know you, what your interests are, what your strengths are, and what your weaknesses are. And you can have a conversation with them, an honest, truthful conversation, and you can make decisions together about what to do moving forward with regard to investments that are going to provide you quality of life for the rest of your life.
So I like this one. Keith, you brought this question to me, and I loved it because it's I've had clients allude to it and dance around it, and it's, how do I get answers to the things that I don't know? And you know what? I got to be honest, and I'm going to give again my little golf clap here to the audience, to you, because so many people, when I asked the oil question, said, "Dude, I don't know, man. I really don't know." And that's the humility of that, and just saying, I don't know what's going to happen. That's you raising your hand and being like, you know what? Let's get somebody here that does know. And that happens in our business all the time. We have such a vast landscape to know that we have to use the resources that are at our disposal. I can't even imagine what's, just a, layman investor, Joe Smith investor out there is trying to navigate today, because we do this every single day. We work with a multitude of clients. I tell my clients that I've retired 100 times and they're going to retire once. And so it's like, I've helped my clients make these financial decisions numerous times. So how do you get the answers that you don't even know that are out there? So Keith, this was your question. What's your answer to this?
Work with somebody who does know. It's simple, and a lot of the simplest answer hides in plain sight. But find someone that you can trust who does know the pitfalls, who does know the most common made mistakes, who does listen more than they talk, and who does get to know, and who gets to know you, what puts a smile on your face, what keeps you up at night, and combines all those things and puts them all together. Taylor, I'm sure you've had clients that want to run their own show, and I'm sure you've had clients that probably do it fairly well. We can recognize that, and then when that happens, I'm thinking of one client in particular here who's made wonderful recommendations of things because he's worked in the industry all his life, made recommendations to me, and actually educated me on his area of expertise. And I so appreciate that. And so what a good advisor will do is, that's the get to know you thing. That's the listen more than they talk thing, at least at the very beginning. What's your experience? What have been your past mistakes? Things like that. So there are a lot of ways that a team can work together. And you have to admit, going back to the very beginning of this question, what do you do? How do I know? I don't know what I don't know. Find somebody you can trust who does know, to help guide you along the way.
Yeah, and I'll point to this, really the root of this is that uncertainty. And that's what the question is, in my opinion, asking. Because again, just with my conversations, I ask, well, what questions do you have? And their answer to me, by and large, is, I just don't know what questions to ask. And that again is where they just don't know. So we start to walk through. One of the things that we always talk about is, what changes could be made. We walk through all of that. We walk through, almost line by line, the different positions that they're in, and say, maybe we could take a loss here and redeploy the capital there, or we could, this has a great income stream. That's why we bought it. Because at the end of the day, we have to be able to answer the question, why? Why did we buy this, and what's the rationale behind that? And so, uncovering those unknowns. I believe it was Donald Rumsfeld, if I'm probably misquoting him, is he was the first one to really bring the unknowns under the Bush administration. And to that end, this is where finding out what you don't know about your portfolio. Some people are going along thinking that everything is great. They look at their returns in 2019, and my goodness, that was a fantastic year. They were up 28, 32, 41%. I don't even know. But then all of a sudden, things really got ugly in 2020. And they didn't know that. They didn't know how they were positioned. They didn't know that they just liked the fact that they had those good returns in the previous years. But then they got over their skis, and they didn't realize that they were about to take a header into the moguls, and it was going to be ugly. So schedule a one-on-one meeting, a portfolio stress test with one of our advisors, and that is where we will uncover some of those unknowns to you and help you gain certainty, clarity, and a better path forward for your financial situation.
Taylor, before you move on, you pointed out something that's just so important. I want to just spotlight that a little bit more, and that is to know the why. That partnership you have with an advisor, that person should arm you with the answers to that question. And I say answers to a single question because it applies as to why you own what you own and why it is likely to be a good investment over time. Two things, and you should know both of those whys. And that's what comes from working with an experienced advisor that will take the time to get to know you and help you make the decisions about what's best for you over the long haul.
Absolutely. So this is the granddaddy of them all. This is my favorite question that we've been dealing with, and the number one thing that you need to know, and how can I protect my investments and my retirement income? So you and I fought a little bit about this one, and you wanted to make sure that we added the retirement income piece, and I totally appreciate it. Knowing that many of our clients, our audience that we talk to on a day-to-day basis are in retirement. So Keith, tell me, what's the strategy? What's the rationale? Walk me through what your answer to this is.
Well, imagine a pyramid. The bottom of the pyramid is the largest part of the pyramid. Imagine the pyramid sliced into three sections, okay? There are three sections. The bottom of the pyramid looks like this. There's the middle, there's the top of the pyramid, and there are three sections as you go vertically up and down in the pyramid. The bottom of the pyramid is foundational investments, money that will generate income that you can depend on. It's as simple as that. And there are more sources of that than you might realize. And not all advisors and not all companies in this industry will allow you to avail yourself of those sources, because a lot of companies have their own favorites. What we do is we look for the best thing for you, the best thing for you. Each client is an individual with individual needs, goals, and challenges, and dreams, and bucket list things. And so that foundational piece is so important. That foundational piece is the rock solid piece that really, in a situation like we're going through now, really doesn't change. The income continues. Value may vary a little bit or not at all, depending on what the choice is. And it takes away a lot of the worry. That's the largest chunk of the bottom of the pyramid, okay? Go to the middle part of the pyramid. That's income. Income that will be there for you. Income that you can depend on, okay? And so then you say, well, what's the top? The top is growth. You don't want to say, no, growth is too risky. I don't want to go there. No, you do. Because you need something to keep you ahead of rising costs as time goes on. These are things that are of huge importance for people who are approaching retirement age. And when I'm saying approaching, I'm saying your investments should start to shift in this direction as early as 10 years before you retire. And there are a lot of wonderful things that can be done to make sure that then those retirement years, because you've planned for them, are the best years of your life. So that pyramid might change a little bit. Those allocations might change a little bit if you're Taylor's age.
Yeah, absolutely. And that's what I alluded to earlier, is that this is an evergreen type of approach, that if you are 35 or 45, the amount that you have in the protected or the foundational might be different. You know, in our world, we use, in some cases, a fixed indexed annuity for those folks that are in or near retirement to create guaranteed levels of income. We can't use the big G word very often, but we can when it comes to using certain things like a fixed indexed annuity. Now, if you're 40, I don't know if a fixed indexed annuity is the right fit for you. It might be, but it probably isn't. And in that case, we need to figure out other ways to protect your family in the event that something goes awry. If somebody loses their life and you need to help out with, a mortgage payment as an example. And then from an income perspective, there's also that for retirees, you've been accustomed to a lifestyle throughout your working years. I talk about this in a very interesting way when it comes to planning. And it hit me a while ago where during your working years, your lifestyle is driven by your income. You say, okay, I can understand that. Run with me here, Keith, and my audience here. So your lifestyle is driven by your income. If you are, like a lot of our clients, fiscally responsible and don't spend a ridiculous amount and drive up credit cards and all that, you live within your means. Let's say your household income is $100,000. Using that number, your lifestyle is going to be $100,000 if that's the net that you arrive home every week or every year. Now, when you go into retirement, your income is going to be derived by your lifestyle because you become accustomed to a certain level, and therefore we have controls that we can meter these things. So building a protection or a foundational approach with income and growth can be in alignment with what you ultimately want to do, because you don't want to just go onto a diet when you go into retirement, a financial diet that is, where you're cut off and then all of a sudden you need to cut your expenses by 20% or 30%. That's really just not fair. If you know what the strategy is and you know how to get there without taking ridiculous risks, that is how you can build long-term financial security and create a really solid financial plan.
Taylor, it's interesting you talk about control and what can we control and what can't we control. We're living through a time right now with something that's affecting virtually everybody on the planet, something that we can't control. Whether it could have been controlled is another question, but we weren't the ones to do that. So now we're controlling it as best we can, but you can't control the fact that it happened and whatever effect it has on what your investments were now. Question is, could you have done things that you can control earlier to have made it through this in a little bit better shape? There are 5 things that you can control with an advisor: taxes, cost, risk, volatility, and diversity. Taxes can be huge. Taxes, as we've said in past webinars, can be the largest bill you pay every year for the rest of your life. Cost, yes, costs should be held down whenever possible. Risk, that's huge. How much risk should you take? Are you Taylor's age or are you my age? Are you young and working and accumulating, or are you depending on what you accumulated for your retirement income? The risk question has a whole different answer for those 2 scenarios. Volatility, depending on the choices you make, may not be that bad, but you have to be armed to keep your sights on your long-term retirement plan. And we're living through an example of that right now. And finally, diversity. Think about a piece of wood, like a piece of pine where the grain all runs in one direction. It's easy to break that piece of wood. Now think about a piece of wood you might find on the forest floor somewhere that came from some old tree, and the grain is running in all different directions. You can't break that piece of wood. That's what diversity is in a portfolio. You may own some things that are subject to unrealized loss in a situation like this, but they might provide you income. They might provide you a solid long-term potential growth in a retirement income plan. But how much of it should be that's the question you need to answer. So control is a very interesting question, and it, in my view, it needs to be done professionally, and it needs to be done with where the client has a full understanding of, Taylor, all the whys.
And the other side of that is, what else can you control? You can control who you work with. And at the end of the day, that ultimately is in your hands. And you have all the power in the world to make that decision. And if you felt like that our information today was worthwhile, for those folks, I do see the attendee list. It's nice to see some great names on that list, folks that I work with directly, that Keith works with directly. And so for those folks that do not work with us already, this is a great time for us to schedule some time to speak, because we are at home. We have been forced to stay home. So I know that a lot of the people that are very busy, that were going to go on that trip to Europe, well, those plans are on hold. So this might just be the perfect time to take the reins and take control of your current financial situation, and maybe shift the trajectory of where you're going to be going. So with that said, use the schedule now button on the portfolio stress test to sign up for your portfolio stress test. That's going to be a one-on-one call with one of our advisors, where we'll start to uncover and dig into your specific financial situation, specifically as it's related to your investments. So with that said, Keith, I know that that you're a wealth of knowledge, and you've got some amazing things to share with the folks here today. Any parting wisdom that you want to help us out with, and end this thing on a positive note?
Something I just saw in something I did with professionals that I have respect for earlier this week. Three things to rely on: that math and time are more powerful than feelings and hope. Think about that in choosing investments. Math and time are going to be more powerful than feelings and hope. Two more: discipline is far more powerful and far more productive than greed. And patience will reward you much more than fear. We are Presidential Wealth Management. We're ready to answer your questions and to help you achieve your goals. Starts with just a phone call. You can reach us at 303-694-1600.
Presidential Wealth Management securities and investment advisory services are offered through Forta Financial Group, Inc., a registered broker-dealer, member FINRA and SIPC.